Hi, Dr. Dale. I have a question regarding non-retirement brokerage account. I put monthly deposits into a total stock market index, a international stock market index, and a Vanguard intermediate tax exempt fund. And the latter is probably about 25% of my contributions each month. I'm just wondering if I should still be contributing to that Vanguard intermediate tax exempt fund. It is essentially just keeps going down. And I guess it's essentially a bond equivalent. And I'm not sure if it really makes any sense to be owning that in a brokerage account right now. I'd like to get your input. Is there anything else that you would do to replace that? Is there any other bond equivalent which is worthwhile? Also, I have accumulated a decent amount within this Vanguard Intermediate Tax Exempt Fund over the last several years. And is it worth selling this and buying stocks or something else? I'd like to get your opinion on this. I'd really appreciate your advice. Thank you very much.
What you are asking me is to peer into my crystal ball and tell you if municipal bonds are going to go up in value in the next year, 2 years, 5 years. And the answer to that question is, I have no idea. My crystal ball is cloudy. The reason why that particular bond fund, and that's what it is a municipal bond fund, it is a tax-free bond fund, has gone down in value, is because the bonds in the fund have gone down in value. Why did they go down in value? They went down in value because interest rates went up. When interest rates go up, bond values go down. Now their yields go up, and thus their future expected returns go up, but their value goes down. So you've listed the three main holdings in my taxable brokerage account. Total Stock Market Index Fund, Total International Stock Market Index Fund, and the Vanguard Intermediate Tax-Exempt Bond Fund. Those are major holdings in my account. And guess what? In 2022, I lost a lot of money on all of them. You know what? They're all going down in value. But that is not a reason to sell them, aside from tax loss harvesting. Tax loss harvesting is a way to make, some lemonade out of lemons. And I have been tax loss harvesting all three of those funds in 2022 so that I can use those losses to offset ordinary income, to offset future capital gains, et cetera. But I'm not going to bail out of my chosen asset allocation because something went down in value. If you do that, that's called performance chasing, and it does not work out well in the long run. You are far better off sticking with a static asset allocation throughout the course of your investing career. 30 years of working, 30 years of retirement, that's your investing career, maybe 60 years. There will come a day when those muni bonds have their day in the sun. Okay? That day is not the first half of 2022. This has been one of the worst markets for bonds in years and years and years. Okay? They now have higher future expected returns than they did 6 months ago. But they haven't had good returns. And anybody who tries to tell you they are has no idea what they're talking about. They're probably down, 6, 8, 10% at this point. Not as bad as stocks. Obviously, stocks are down 15% plus. But, they haven't had a good return recently. But if you look in the long run, they've done fine. And you should expect them to do better going forward than you expected them to do 6 months ago, given what the valuations were at that point. So what do I do in that case when something has gone down in value that I think is a good long-term holding for my portfolio? I buy more of it. Yep, I'm buying all three of those. Have been all year. I'm pouring money down the rat hole, just like I did in 2008, just like I did in 2011, just like I did in December of 2018, just like I did in March of 2020. Okay? This is what you do. When markets go down, you rebalance, you put money into the lagging assets. And you know what? 5 years, 10 years, 20 years down the road, you're really glad you did that because those are the best returns you got on those assets. Now, if you decide you don't want bonds in your asset allocation for whatever reason, then I guess you got to change your asset allocation. But, doing that typically results in you buying high and selling low. I would submit that there's probably a reason you have bonds in your asset allocation. You ought to go back to your written investment plan and realize what that reason is, and then stay the course with whatever your plan is. Hope that's helpful. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.